$14 billion Bitcoin options contracts are set to expire on Friday, today. And there is one specific price level acting like a gravitational pull on Bitcoin's market price. That number is $75,000. And there is a very specific mathematical reason why that level is being treated as a magnet by some of the largest institutional traders in the crypto market. Nearly 40% of all active Bitcoin options on the world's largest crypto options exchange, Deribit, are set to expire in a matter of hours today. And this kind of concentration doesn't happen every week, every day. This is quarterly expiry, one of the biggest events on the crypto derivatives calendar. And when you understand what happens mechanically during an event like this, the way markets move will start to make a lot of sense to you. Now, let's start from the foundation, because if you don't understand what a Bitcoin options contract actually is, none of the rest of what I'm going to talk about will make sense to you. So what is an options contract? Think of it this way. Imagine you want to bet that Bitcoin's price is going to go up over the next month. You have two choices here. First option is to go and buy Bitcoin on spot directly, simple, like the way we do. You own the asset. But there is a second option. Instead of buying Bitcoin directly, you buy a contract, a piece of paper that gives you the right to buy Bitcoin at a specific price on a specific future date. That contract is called a call option. Now, let's say Bitcoin is trading at, we'll round it as 70,000. It's currently, as you can see on the chart, 68,000, but let's put it as 70,000 to make it just easier. Today, and you buy a call option that gives you the right to purchase Bitcoin at $75,000 on Friday, today. If Bitcoin price shoots up to 85,000 before Friday, which is before today, your contract becomes incredibly valuable because you locked in the right to buy at 75k. You can either exercise that contract and profit from the difference, or sell the contract itself for a premium. But if Bitcoin never reaches $75,000, your contract expires worthless. Basically, you lose the premium that you paid for. It's essentially like a lottery ticket with an expiry date, basically. On the other side of the trade, you have what's called a put option. A put option is the opposite. It gives you the right to sell Bitcoin at a specific price at specific future time. So if you think Bitcoin is going to drop, you buy puts, the so-called puts. If the price falls below your strike price, your contract becomes valuable. Now, the people on the other side of these contracts, the ones selling or writing these options, are usually large institutional players, hedge funds, market makers, big trading desks. They collect the premium upfront and take on the risk that the market moves against them. This is the ecosystem, in a simple way. Buyers paying premium for the right to profit from big moves, and sellers collecting those premiums and hoping the market stays relatively calm, so these contracts expire worthless. Now, why this expiry matters so much? Because every single one of these contracts has an expiration date. When that date arrives, every open contract either pays out or dies worthless. And that's what we call quarterly expiry. It happens, of course, only 4 times in a year at the end of each quarter. And these events are significant because they force massive position adjustments across the market. So traders who have been holding their positions now for weeks or months have to suddenly do something with their position. Either close it or roll them into new contracts or let them expire. Simple. And all of that activity, all that buying or selling creates price movement. Now, some quarterly expiries pass without much drama, but others create significant volatility. What determines which category each expiry is in or falls within? That's called the max pain concept. And that's where the 75,000 level, which I mentioned at the start, enters the picture. In the world of options, every strike price, meaning every price at which levels can be exercised, has a certain number of open contracts sitting at it. Some strikes have a lot of open call options, others have a lot of open put options. Many have both. The max pain is defined as the price level at which the greatest number of contracts would expire worthless if the asset were to settle there on expiry day. In other words, it is the price at which option buyers lose the most money collectively. For this Friday, for today, Bitcoin expiry, the max pain is $75,000. And if we try to think in an institutional way, institutions collected premiums from buyers. Their goal is as many of these contracts as possible to expire worthless, because if a contract expires worthless, they keep the premium without paying out anything. So if Bitcoin settles at $75,000 on Friday today, the maximum numbers of buyers get wiped out, and the sellers, the big institutions, the market makers, win. So the incentive for institutions here is to nudge the price towards $75,000, not necessarily through manipulation, but through normal mechanics of hedging or just buying and selling activity, and the gravitational pull towards that level. And why we have so much pull towards the 75k level? First, options expiry mechanics, which I just explained. This is the max pain level, the price where most traders lose money. And the second is 75k is a very strong major technical resistance and a psychological round number, a level where traders take profits, a level where selling pressure has historically stepped in. And now we have two forces colliding at the same price. Of course, that's not a guarantee. Some expiries, as I said, go without much drama. In a nutshell, we have three main scenarios to watch here. Price moves to 75k, to this gravitational pull area, gets rejected, and we see short-term drop after the expiry. That's option one. Option two, we never go to 75k and institutions cap the move. Price never reaches to 75k. And option number three is price breaks and holds above 75k, which in my opinion is not very realistic at this stage. We'll see a strong bullish continuation after that, and that would be bullish for the markets, and we can see 80k coming very quickly. Although I don't think this is possible at this stage. We're likely going to never reach the 75k and just continue in this consolidation pattern. And of course, right now, macro shocks, political, and especially the geopolitics can override everything. Every kind of analysis, every kind of theory. That's what is driving and dominating the markets right now. So I hope you found this video helpful. If you did, please don't forget to like, subscribe, and share. Thanks for watching. I'll see you in the next one.